Great. So in today's section, we're going to look out for the continuation of the footnotes. We're still looking at the footnotes. We started last week and we did only one out of the three. So in summary, we had the footnotes. We demarcated or grouped into three. They are first, some of the footnotes are in the form of what? Adjustment. Number two, some of the footnotes will be in the form of errors or omissions. Look at one. Some of the footnotes will also be in the form of IFRSs, the necessary ones. Last week or in our previous lecture, we look at the errors. So today, in the first 30 minutes, let's look at the adjustments, the first part of adjustment. Then we go for first week. Come on. Okay, so let's quickly go straight to the game. Adjustment. Now, if we pick the adjustment, I've also grouped the adjustment into three. The adjustments are also grouped into three. We have accruals. We have prepayment, right? Again, we have bad debt and provision for what? Bad debt. And provision. So for today, we need to finish all these three. Starting with, I'll look out for the accrual first. Before our first page. Okay, so let's look at accruals. Accruals, as the name suggests. Now, when you talk about accruals, it simply means owing, outstanding, unpaid, arrears, left out for, and then balance left. So basically, that is the meaning of accrual. Accrual simple means item that either we have consumed or service that we have probably delivered, but have not received or paid the money. That's the meaning of accrual. Owing, outstanding, unpaid, or you have not received the money. That is accrual. Basically, there are two types. Now, I'll pick the revenue or income accrued and then expenses accrued. So we look at these two and then we are done. So let's go straight to the game. I'll start with revenue. So revenue accrued, what is accounting treatment? Revenue accrued simply means it's an income earned, but not received or yet to be received. Income earned, but not received. You have earned the money, but you have not received the money. That is all. So how do you treat such item? So if you see any footnote, that is going to inform that, oh, they've worked for 12 months, but the amount given to them is just 8 months. That means the remaining 4 months are in what? Arrears. How do you treat such transaction? So let's see, two treatments. First, tell the examiner that according to our accrual concept, whether we have received the money or not, it should be part of our revenue. So we say add to the related revenue. Add to related revenue or income. So you can add income here. So that's the first thing, because it's for the period, it's for a year. So it must be added to the year's revenue or income. That's the first thing that we need to look out for. Then, second, footnotes, those that on their own need to be treated with 2 times. So the second part, this is a plus to us, a minus. You have earned some money, but it's not paying you. It's not received the money. Is it a plus to you or it's a minus? It's a plus because at least someone's doing us, right? Good. You can put the person's name in our books as well, receivable. So add it to all plus our current assets. So add to current assets. That is all. So that is the treatment. Add to current assets. And then we are done. Okay. Now let's back with what? With illustration. Let's assume that in our trial balance, we are assuming that in our trial balance, this is a marriage trial balance. I can see rental charges or rental income. We are renting part of our premises to other companies. And then in our trial balance, we can see 40,000 in the trial balance. That means that is the amount received during the year. So during the year, they've given us what? 40,000 cedis. Let's assume I pass a note. Note 1, in a footnote. The rental income in the trial balance represents 8 months rent. Okay, so if the one in the trial balance represents 8 months, no, in a financial year too, we have what? 12 months. So that means we are doing what? We are owing some 4 months, they've not received rent. And it's an income. Once you have enjoyed the facility, you need to pay us. We've earned it. So how do you treat this remaining 4 months? We are saying that relax. If you want to treat the 4 months, just calculate the 4 months and then pass it in like this. So you kindly calculate the 4 months amount for me, and let's see something in here. Okay, so if 8 months is equal to 40,000, then 4 months will be what? Okay, good. 40,000 divided by 8, right? Which is 5,000. That one is only for a month. Because if I pick the 40,000, that 40,000 represents what? The entire 8 months, right? So if I divide by 8 like this, the answer that you give me will be what? Just for 1 month. So 1 month is what? 5,000. So monthly rent is 5,000. How many months in arrears? 4 months, right? Okay, so times what? 4. And that'll give us. Now, you know how amount statement is, right? They're not too straightforward. I suppose they need to tell you that, oh, they are owing rent 20,000, simple. But look at where and how we stated it. So you suffer elected before you arrive at the 20,000 before you go into the accounting treatment. So basically, that is how we are going to work with it. So tell me how you're going to treat this 20,000 in the financial books. So the 20,000, take the examiner, relax. This is what? Income or revenue in arrears. So if I get a proportion, the proportion which is in arrears, it must be first added back to what? The main revenue. Second, add it to your current assets, basically. Then you are done. Okay. So let's quickly pass the entries and then we move on. So in our financial statement, we are going to present this as follows. So first, 2 entries. What will go or what will be recorded in our profit and loss. So let me assume that is our profit and loss here. In the profit and loss, tell the examiner that when I go to other income, and then write rental income, I open a bracket. It's the examiner. They've received 40,000. But let me know how much to be received again. So plus that 20,000. So now the total rental income should be what? 60,000 in your P&L. Now when I write other income, I don't have any challenge because you have of other income is position, right? In a profit and loss. Good. Then I'll go to my financial position, the balance sheet. I'm going to record it there. So when I go to financial position, the balance sheet, I'll go to current assets. So see, and record. And the current assets, I examiner rental income, owing or arrest. The figure is what? That is all. This is a relevant aspect. You are done. That is all.
So at the current asset, you don't add the 40,000.
No. At the current assets, the 40,000 will not come again. 40,000 has been accounted for. Once in the trial balance has been accounted for. All the items in the trial balance need to be treated how many times? Once. So the 40,000 has been added to other income here. It ends there. All the items in the trial balance left with just one treatment, then they are done. But the items in the footnote, those are on their own 2 times because they are new. So after the 40,000 in the other income, it ends there to not reflect anywhere again. But because this 20,000, the one they are owing, they've not treated it at all, we are now going to treat it. So we add it to the other income, come and then do what? Add it to your financial, your current assets. That is all. So this will be the treatment. Now let's continue the game. We are now moving on to, there are 2 types of accruals. If you look at revenue, because we have what? Expenses owing or expenses accrued. So let's go to expenses. Let's go to expenses. So expenses. So expenses accrued. It means that here we have consumed or enjoyed the expenditure, but we've not any payment for. So it means that these are expenses incurred but not paid for. That's all. So any expense that is incurred, consumed, enjoyed, but have not paid for, it's called expenses accrued or owings or arrears. So check the footnote carefully. In the end of the note suggests that they have consumed certain expenses, but they have not paid for. Can you treat it? That is all. Just the examiner will not tell you straightforward that this is what revenue accrued, this is expenses accrued. No, we will not do that. We will pass a note and tell that, oh, everything electricity in the trial balance is for 8 months too. That's all. Meaning that they are owing what? The other 4 months. Oh. Now, we left the invoice of some amount in our drawer. So after the preparation of this trial balance, then we found the invoice. That means that bill has not been settled. But there is no invoice, you can't settle the bill. So that bill is what still outstanding. And this is how we can raise the issue. So you can even tell you that, oh, the source document on which you are going to pay this expense, we cannot find it, right? It's missing from the books. So it means that That bill is still what? Outstanding. It has not been paid. There are so many ways of bringing these issues in the air now. We just have to analyze it and see. Now, what's the accounting treatment? 2. As usual, add to what? A related expense. Related expense. So the expense that it relates to, if it relates to, let's say, admin, can you do an add to admin? If it relates to director's remuneration, can you do an add to director's remuneration? If it relates to, let's say, wages and salary, can you go there and then add into it? That is how we're going to treat this particular item. Okay. Then, second, is there a plus to have as the minus to have? Consume the expenditure or the item, but it's not paid for. That means the money is due. Meaning we are owing, right? Yes. So if we are owing, then must be part of our liabilities. But this time it's a short-term liability. So add it to current liability. That is all. Add it to what? Current liability. Add it to your current liability. So that is that. We are done with the accruals. So I'll move on straight to that of the prepayment to finish the first half. So basically, like that. Now let's look at for prepayment. So everything, I'll give you the shortcut and back it with what? Illustrations. A lot of illustrations. You have a lot of them in the material. So prepayment. Also means paid in what? So advance payment. Advance payment. So at the time that we have done the financial statement, please, the alignment is what? At the time and this that we have done the financial statement, is there any expenditure that we paid ahead of time? That's what we are interested in. Okay. Let me give a critical example. Now, let's assume that there's some bill. You're supposed to settle the bill, let's say, latest. The last day of October, you need to pay that bill. If not to pay it in October, we'll let you pay like 10 times of the money. Because of this penalty issue, you pay the money January to avoid trouble. Now, tell me, your reporting date is also December. Tell me whether this can be treated as what prepayment. Because I can see that you paid it in advance, so deadline is open. But you paid it in January, so that amount to prepayment. So that's online. Let me hear from you. So it means that this is due date, and this is where you actually pay the amount, and this is the reporting date. Okay. So now, in short, if you have done your financial statement from January before October, that won't qualify to your prepayment. If I pull out any financial statement here, it qualifies to what? Prepayment, because I paid ahead of what? Time. However, if I put a financial statement as per December, is there any prepayment? No. As per December, there's no prepayment. So if I'm doing financial statement as per December, no prepayment. Prepayment simply means at the time that you are doing a financial statement, any payment that is made ahead against the following period or the next month, the next year, the next quarter, that is it. Not item that we pay before the deadline within the year. No. So let's check this one carefully. Okay, second illustration on prepayment. Let's assume that we enter into a service contract with some organization to come, and then every year we come and service, repair all our plant and equipment, was including PCs, everything. And then every year is 20,000. We sign for 3 solid years, and we pay the money in advance afterwards. So we give them 60,000. So that means the 6,000, let's say a year ago now, January. The next year, year 2 and year 3. These are 14 years. Okay. Now tell me, if I'm reporting at the end of the first year, what is the prepayment? At the end of the second year, what will be the amount of prepaid expenditure? And then the third year. Good. Now, it means that every month is what? So every year is 20,000 cedis as a month. But we pay all this money to them. We pay all this money, and we haven't it. So what happened is this: at the end of the first year, we've only consumed what? 20,000. So let me.
40,000.
So 40,000 becomes what? Prepaid 40,000. At the end of the year 2, we have consumed what? 40,000, right? Another 20 again, making 40. So meaning we've consumed 20, total of 40. What is the prepaid? Thank you. When you go to the last year, we consumed what? 60. What will be the prepaid? Perfect. So this is how we are going to calculate prepayment. It is probably going to travel for more than a period. So basically, that is that. Now let's start with the accounting statement. So now we know prepayment. At the date that you are preparing a financial statement, any amount paid ahead of time. Now prepayment too, there are also 2 types, right? We have what? Revenue and what? Expenses. So let's pick revenue. Revenue or income. This one is a disaster. Revenue and or income. Meaning that here you have received the money ahead of time. You've not worked for it, but they've already paid you. You've not worked for it too. Like these rental charges. You are the landlord. You have received 3 years rent in advance. So what is the treatment? So here is the income received before you render the service. Income received ahead of time before the actual service being performed. So that means you've not performed the service yet, but you received the amount. How do you treat it? First, now our example. Let's assume that you received 60,000 for the 3-year period. At the end of the first year, 40,000 is being prepaid, right? Good. Now the question is this: is 40,000 is it for this year? No. It's not for this year. So if I'm reporting for this, you only need items that are going to consume and within this period, nothing else, nothing more. We are done. We are reporting for a performance within this period. So any transaction, any foreign material should be what? Removed. So anything coming from here should not be affected this period or should not affect this period. Fine. So finally, it means that if this is 60,000 are paid, it includes payment ahead of time. So what do? Yes, that's all. That's the accounting treatment. That is the accounting treatment. So basically, we are going to subtract because it's not for this period. Third examiner, it's not for this period. Prepayment are not for this period, but the next period. So only subtract from, again, the related revenue or income. That's the first thing that you have to do. Why? Because it's not for this period. It's not for this period. It's for what? The next period. It is not for this period. So don't include it. Second, now is there a plus to you as a minus to you? If you see somebody's money at a time, when it's really well, it's coming to you that the money is not perform the work, not perform the work. So will be a plus to you as a minus to you. What that you have not performed, just give you the money out of time. Yes. In fact, it's good news for you to receive your money out of time, but look, who have to perform a service? You have to perform a service, right? So looking at that angle, then you have a liability. So add it to what? Yes, add it to your current liability. That is all. So any revenue or income that you earn it or you not earn it, but you receive it ahead of time, that is part of what? You call it deferred income or deferred revenue. Deferred income. So basically, that is it. So that is the accounting treatment. Now let's go to expenses prepaid. Expenses prepaid. Then we start with question 7. Expenses prepaid. Expenses prepaid. Expenses prepaid. So let's see. Expenses prepaid. Expenses prepaid. Expenses prepaid. So expenses prepaid, these are items that you have paid ahead of time, a service or a transaction that you have not received but you pay for it. For instance, look at it, how you pay for electricity, prepaid. You have five, let's say, about 1,000 cities, which you cover, let's say, 2 months or 3 months. But at the time that you acquire it, it's not consumed up to 3 months, so you pay for it. Good. So how do you treat this in books? So expenses that you paid ahead of time. Now, this expensive, is it for this period? No. Once it's prepayment, it's not for this period, because for what? The next period. So first, again, subtract somewhere the related expense. Again, B, is there a plus to you or a minus to you? It's a plus. At least, if pay something out of time, you are rather owing us. Yes. So, this is what? Current assets. How did you? Your parent assets. That is all. Now, I am done with this. And I'm going to start backing this to the illustration. So I'll go through all the questions that I have in the material. Those sections that we have, prepayment and then accrual. Before I do that, let me give you the shortcut. Shortcut. What happened is this. In the P&L, that examiner add all owings. Command. And subtract prepayments. That is all prepayments. That is shortcut. So anytime you meet any owings, whether it's expenses or it's a revenue, just add it to the related item. That's all. If you relate to expense, add it to the expense. If you relate to liability, so if you relate to revenue, add it to revenue. That is all. Then subtract all prepayment, whether it's an expense or income. That is all. This is for the P&L. The balance sheet, when you go there, then check whether it's a plus to or it's a minus to, whether you are owing somebody or someone is owing you. That is all. So if this transaction suggests that someone is owing us, there is an asset to us. If it suggests that we are owing someone, then it's what? A liability. All of them are current. That is all, because we expect to pay within 1 year. We are done. Now let's start. Okay, so let's go to question number 3. Into note number 2. So question 3, note 2. Let's see. Okay, so note 2. Question 3, note 2. Input you. Question 3, note 2. Now page number 10. Note 2. It goes like this. Administrative expenses include payment of 5 million in respect of 2019. Let's go to the year in question first. The year in question is what? 31st December 2018. We are reporting when 31st December 2018. But this payment is for 2019. So will it be an accrued revenue or an accrued expenses? But my game has worked. In fact, it's none of the two. It's prepayment. It's prepaid expenses. When I mentioned, yes, I give 2 options that either to be what? Accrued revenue or accrued expenses. So it's none of these 2. It is not an accrued expense, or accrued revenue. It's prepayment. I know my self questions, right? Yes. So, so in short, this is what a prepaid expenses. What the accounting treatment? Prepaid expenses. Accounting treatment. Prepaid expenses. We paid it ahead of time. So is it for this year? Is it for the current year? It's for 2019. Good. So it's for 2019 and we're in 2018. So we need to take it off from the related. So which of the expenditure or expenditure is related to? Administrative expenses. Administrative expenses. Administrative expenses. So in short, and this question we have solved it without any footnote. Okay, so when I'm done with this adjustment, we need to look at the financial statement. So let's see. So the treatment will be as follows. So first, assuming here, subtract from what? The related expense. So it relates to us admin. So let's go to the trial balance. The admin figure in the trial balance. We need to subtract 5,000. Admin value. Admin is what? Good. Admin is 33,000. That means 33,000 include payment which come from this year. So what do? You take it off and go and add it to current assets. So in that note, yes, the 33 is 33 million. If it is so the 5 million become what? 5,000. Perfect. So this is how we are going to treat it. And when I'm done with this, we need to prepare financial statement and then the mass balance. In our P&L, admin will go to where? Operating what? Expenses. All right, admin. After examiner, relax. There's an amount that they pay now, and we'll take it up. So 33,000 less what? Then, don't forget on reporting currency. Let me what? 28,000. So it means that we solve this question without any footnote. Admin, we placed 33,000 there, right? So you're going back and prepare a new set of financial statements where now admin will not be what? It will be what? 28. Again, let's go to the financial position, the balance sheet. You said prepaid expenses are what? A plus or minus? Plus. Good. So meaning current what? Assets. So I go to my current assets straightforward. Third examiner. Prepaid what? Expense. Which will be 5,000. Okay, so the prepaid expense will be what? 5,000. And it must balance nicely for you. How we get it? So this is how I'm going to treat it. How we get it? Good. If I do one, you do one. 1 to 1 mapping. Okay, so that I'm going to mention, you are doing it. Good. That one is a bit heavy. And this. Okay, so let's go to one of the questions called work hard. Work hard. Question 8. Question 8. Question 8. Work hard. Work hard. Question 8. Work hard. Question 8. For the questions, there are 3 sets of questions that we use: example, illustration, and tutorial questions. Question 8. Work hard. Work hard. Tutorial question 8. Okay. Now let's go to note 2. Now it's your turn to work note 2 out for me. So in short, the treatment will be as follows. This investment income of 20 million due the company but have not been received. The company reasonably expects to receive only 85% of the investment income. So first of all, you ask yourself, the entire amount is 20 million, and you expect to receive only 85. So that means 50% are gone. So just take account of what you expect to receive reasonably, accurate. So that means there was a provision of 15%. And that one, we can easily account for the amount you're going to receive. So just find 85% of 20 million. That will give us 17 million. And take records of the 17 million. That's all. It ends there. Or in summary, this is income owing or income accrued or income in arrears. In summary, you can also show a full amount of 20 million. Then take an account of what? 3 million as what? An expense. So, that one is a very long approach. So let's go to the board and look at that we can treat this. Now, what will be the related revenue or related income? Check the trial balance, whether you see investment income on the trial balance, whether you can relate to the one on the trial balance. Let's go. No. So that means if it does not relate to any item on the trial balance, what do? Let's create new column. Have you seen? It does not have a counterpart. Let's create one for him. That's all. So that means let's pick the name of the word investment income from its own. So let's go. Profit and loss, what goes in there, and balance sheet, what goes in there. That is all. So our profit and loss should be under other income. So I'll go to other income. And then after the examiner, investment or income. Open a bracket. That examiner to be 20,000 times what? 85%. Perfect. Close it. Put the answer in 17,000. Please and please again. Don't put this one on the calculator and throw in the answer. Other than that, you send 26 home. It's called only one. Okay. Go to your financial position and a current asset. Record investment income only.
You said we shouldn't on I didn't get it.
Good. Meaning that you have to show the workings clearly how you arrive at the 17,000. Because any figure that is your answer sheet, which are not the person, can you tell us how you arrive at them? Any figure which is on the answer sheet, especially for you the paper based. Tell us how you got that figure. So when you go to a financial position, add it to your current assets, so investment, income, owing, and amount to be what? 17,000. What done? Yes. Exactly. You have to get us. That's what. Owing, investment, income, owing. Oh, yes. Good. Alternative. That one is long approach. I like this one. You can also record the entire income of what? 20. And among your expenses, you make a provision of what? 3,000. Let me do what? 17. You take this 17 to the balance sheet, as you see here. But I like this section, and then you move on. Don't have any issue again. Good. That 15,000 or that 15%, which is the 3,000, probably gone. Don't need to account for it again. So that is it. Okay. Now we are done with this question. Let's continue again. Let's come back to input your question number 3. Page 10. Let's go to note 8. Question number 3, note 8. Question 3, note 8. So that one is on my 10, right? If I can go and do one. Okay. So I will do this one. Note 8. Yes. A grant of 2 million. What I told 20 million. Yes, what? Okay. You also see something here. A grant of 2 million was promised by the government I'm sure the Ghana government. In January 2018, our condition that a company opens a branch in a rural community and employs what 70% of that staff requirement or the staff requirements of the branch from indigents of the community. The company has already complied with the grant conditions, but reasonably expects to receive only what 80% of the grant promised. The transaction has not been recorded in the books of the company. Full stop. Okay. So, suitable criteria. This is what? Grant. Grant is an example of what? Other income. Because nobody registered in business to receive a grant. That is, they always like donor support. If you're into commercial business. So the grant become what? Other income. Now, even though this fall under IAS 20, it's not an IAS 20, but there are some of across the documents you have to self-respect. Grants come with condition, you fulfill the condition. They promise you 2 million, right? But reasonably, how much do you expect to receive? So here, how are you going to record this? 80% of what? The 2 million, that is all, the rest vanish. Over there in work it was 85%, but this one is what? 80. And so you take 80% of the 2 million and you put it in. So 80% of 2 million gives us 1.6 million. So that's 1,600. If I go to the board, I don't be confused about the 70% that they place there. Yeah. That 70% is a condition, and you comply with it. So that is all. So the 70% is not this. So in short, in this question, I just have to clean this one, and then clean this one too. And third examiner. Grant. Open a bracket. 80% times what? And that will give me 2,600. That is not 2,600. Good. This one. So sorry. Let's see. The same thing come here as what? Current assets. 1,600. So that would be 3. Now we are done with this. Let's go to question number 4. If you have question 4, we call it we are done. And that one, you try that one. So trying, you are done and finish that. Then I'll move on with the next section. So question number 4, which is we are done. We are done limited. Question 4, we are done limited. So look. That's note 4. The last sentence. Page 36. Note 4. The last sentence. And that note, no, you're not reading entire, the last sentence. However, let's start from that side. However, rental income of what? 0.20 million on the investment property has not been received But the company reasonably expects to receive what? 75% of this. Good. That's page 36. Note number 4. Note 4. The last sentence of note 4. So tell me how we should treat this. If you want me to move to the financial or the travelers, I'll do that. I'll do that. For you to look for, okay, rental income. There's a rental income of 360 on the trial balance. So tell me the full treatment of this. You do have only 2 minutes, which is 144 heartbeats. Yes. So I'm using my heart to count. Yes, on a travel balance, I can see rental income from investment property 360. From investment property. 360. And then there's a foot to the last sentence. I'm using the last sentence. So we have 144 heartbeats. Okay. So it moves like this. The rental income of 3 million on investment property has not been received, but the company reasonably expects to receive 75% of this amount. So in short, find 75% of the total 3 million and go to the balance and see what is the rental income there. Yes, the rental income of 360. You add it to it, and then you can. Let's see how best you can work this out. So in short, and let's have to change this one from ground to what? Rental income. And the figure. So I'll put a bracket like this. That is now. Rental income. Open a bracket. And the trial balance, they have 360 there, so pick it. If there's no figure, the trial balance, 0. Plus the proportion that they are owing. So now it's 0.3 million. We're working in thousands. So first, multiply this figure. 0.3 by what? 1 million. You get something like 300,000, right? Comfortably, because of these 3 zeros, cancel the last 3 zeros. So now let me do what? 1 million. Because 0.3 million. Originally, they stated 0.3 what? Million. So million have how many zeros? That's have to matter about 1 million. So that we can now get a full figure. Okay. We cannot be populating 0.3 million. No. So that is it. So first thing, if you're confused about this figure, because sometimes you get a figure like 0.32 million. Exactly. Then comfortably cancel the last 3 zeros. Left with what? 300. So that means 300 times what? 75%. If I work this one alone, it give me 225. When I add 225 to this figure, I'll now get something like 585. That should hit my P&L. Then,
but can you also work out the entire? And then when you get it, then you cancel the last thing.
Can we do that?
And then put it. It will be too long.
Okay.
Then when I go to the current assets, and after the examiner, Mr. Examiner, we have something in here called rental income owing or in arrears. of 2 to 5. And so we are done. Okay, I have to give you a trial. Now you are doing finish hard. That's the next question immediately after this very one. Finish hard. That one is a trial. So you try it probably at home. That tomorrow after church, you get church work. Finish hard, question 5. The next after this. This one is question 4. We are done. Question 5 is what? Finish hard. Only look through the footnote and locate whether there's what? Prepaid or accrued expenses or revenue in it. And treat it for me. On that note, yes. On that note, I am done with the first half of the adjustment. Let me go and end it with the last section, the adjustment. Today, I have to end adjustments. Next week, I'm starting with the heartbeat, the IFRS, the stubborn virus. The guys I already mentioned, the non-account students are not happy. The guys I already mentioned, non-account students are not happy. Okay. So what's the third aspect of adjustment? That is bad debt and provision for bad debt. Let's go. Bad debt. Now, who will tell us the meaning of bad debt? Okay. Bad debt. Yes. If you cover both debts. Okay. Can I also say that it is that which has gone bad? I can't say that then. Okay, fine. In fact, bad debt simply is debt that cannot be recovered, cannot be retrieved, cannot be received. That's all. How do you treat it? Now, it must be written off. It must be what? Written off. That's all. Meaning that it should be written off in the books. Any debt that you think and you recover. Now, cause of this could be bankruptcy, debt, running away, hiding, and other factors. Now, we are not interested in the cost, we're interested in the amount that we are going to pay. So that's all. Now, the treatment of bad debt probably might depend on where you see it. So, 2 places. So, first, if you see bad debt in the trial balance, just add it to your expenses, add it to your operating expenses. Okay. That is all. That is admin and distribution cost. So, bad debt is usually part of that distribution cost. The admin. So in short, we are having to operating expenses. Even in a trial balance. Now we solve a question called H1. H1 limited. In a trial balance, there was a budget. In a trial balance, there was a budget of 2,000. That is H1. So we added to the operating expenses and then that is all. So we see bad debt in the trial balance, only just add to operating expenses at the end of the game. That's the end of the story. That does not reflect anywhere again. Please and please again. All the items in the trial balance, the treatment is what? 1. So just know where you are going to send items to. That is why when we start the game, we pick empty trial balance and we posting it. So now you know all the position When I set the question and the graph balance, I have 30 items in there. That means I am telling you that you have 30 free ticks. If you can tell me correctly where they must be reported or where I put the treated, that is all. That's why first we start by knowing each of them their position. So even if you know that this figure will go here, if it's sending there without adjustment, one tick for you for sending it there. How we get good. So that's it. I'm done with budget in the trial balance. Let's go to the habits. If we see budget in the footnote, how do you treat? That's the main target. Budget in the footnote. If you see budget in the footnote, it calls for 2 treatments. Now, any debt in the footnote, it means that that not be what? That debt is still hanging. So let's assume that you have given 20,000 out to someone as facility with a group of people. Among that person, one of them is planning to die or decided to die. He owes, let's say, 2,000 cities. How are you going to treat this 2,000? Where this 2,000 are not been accounted for? If you see any budget in the footnote, it means that it has not been accounted for or written off. So the first thing that we have to do is what? To write it off. So first, write all budget off. The one in the footnote. How do you write the debt off? If 2,000, I'm not going to receive. So what's expected? With what? 18,000. So that's this exercise is called written off budget. We have write off 2,000 against the receivable. Good. So treatment number 1, if you see budget in a footnote, first then write it off. First then, so it must be written off. The written off stage will be subtract from where? From the trade receivable. So that is what we have done here. Good. So the total amount due, you are not going to receive that amount. So net off all the amount that one. But budget will probably reduce your receivable. Again, it's an expense plus, and you add to what? Your operating. So if you see budget in a footnote, it calls for 2 words treatment. 2 treatment. That is all. Yeah, from the trade receivable. Trade receivable. On the debtors figure. Meaning that you are now going to write it off. But if you see bad debt in a trial balance, that will be told you probably write it off. That's all. So written off and done already. That is the term. Okay. Now we are done with the first page. Let me back with what illustration. Let's go to question number 2. So question number 3. Input 2. Input 2. One of the notes. Input 2. The first part of the notes. Input 2. That's question 3. What is the note? Note 4. Budget of 0.8 million is to be what? That's a good examiner. They're saying inform what to do. Oh, that's a good news. Let's tell you that, oh, one of the customer owing in Bundio recently declared bankrupt. And owing the amount to, let's say, 500 or 0.8 million. In Bundio have not taken an insurance cover. Full stop. I'm done. Obviously, irrespective of the reason, once you are not going to receive these funds, kindly treat us for marriage. So this, tell me the accounting difference. First, what do? Subtract it from where? The trade receivable. That's the first thing. In fact, it must be the very first item that you do. Second, what do? That is the witness. That is the end of the game. Let's go. It's true.
So in the same thing that this the PLL starts first.
Then is this. You know, sometimes I use that for the balance sheet. And finish the balance sheet, what comes to the PLL? Or we start the same time. When I done I will walk you through.
No one is the I know that is done.
Great. So in short, in this particular question, the entries will be like this. What goes to the P&L, what goes to the financial position? That ends the game. So, even though that's the second section, I'll tell the examiner, under my operating expenses, I shall have a bad debt. Bad debt of what? This one is not 8 million. So if you got 800, 800,000, and then raise the 3 zeros. Perfect. When I go to my financial position, under my current assets, when I mention trade receivable, open a bracket. So go to the trial balance. Any trade receivable is here. Kindly pick that figure and less 800 for you. That's all. Let's go. The trial balance. Trade receivable, why? Trade receivable, okay. Trade debtors, in fact, they use trade debtors. No. So the receivable is the same as debtors, right? So 6,000, I'll give it. Okay, so 6,000. So I'll come here and tell the examiner. This 6,000, I'm not sure you can receive all this money. 800 has gone bad. So let's take it off and know the actual receivable of what? So if I should end here, the correct receivable figure is what? 5,200. That is all. So that's the treatment of bad debt in what? The footnotes. I am done. I'm going to the last aspect of bad debt. That's the provision. Let's see. Okay, so now let's move on to provision, or provision for bad debt, or provision for bad and doubtful debt. Provision. Provision for bad debt. Let's see provision for bad debt. Provision for bad debt. Provision for bad debt. So provision for bad debt, or provision for doubtful debt. Doubtful debt. Provision for doubtful debt. Okay, now a quick difference between provision and the bad debt itself. So provision for bad debt. Now the difference between provision for bad debt and what? The bad debt itself. Tell me, I just need one. That's all. When you say provision for bad debt, we also call it allowance for receivable. Allowance.
I'm saying assumption.
Okay, I'll take that. Now, provision for bad debt is like a reasonable estimate of the amount that is suspected to not be received. So that one is just a percentage or just a proportion of the entire debt that you suspect that you're not going to receive it. So you're making provision for it. But bad debt, that one is gone. You're not going to receive it at all. So there are two things. The provision, you have given, let's say, 20,000 to someone. I say, okay, this money, I suspect that I must not receive 2,000. So let me start making provision towards that lot of 2,000. But bad debt, oh, maybe the person has run away with the entire 20,000. That one is what? Bad debt. Even as bad debt, it has probably occurred or crystallized in the books. Provisions, no. You anticipate that, this man will not pay all the money. So let me put some small money in the books. In the event where, okay, not pay the full amount, I don't stand to lose anything. That is all. So that's the difference between what provisions and what the bad debt. Basically, because it's anticipation, it's in the form of percentage. So I suspect that 5% of the amount will not be received, 2%, 3%. And here it is a good practice to estimate the past history or the past event or the past transaction about that customer and know that this customer, when I give him the money and then last 1,000 cities doesn't say. So I'm not giving the money to that customer, make a provision for that 1,000. When it left 1,000, this one will get the money. So put it in. Good. So that is it. Now, what is the treatment? We will go straight to the point. Provision is an account that I'm going to prepare. Okay. Balancing figure is what I want to send to you. That's all. The P&L. But we have a statement version of the account. Most of us are not accountants. So we are going to use the statement version. And that one is very good. Let's see something here. So the open provision for bad debt account like this. That examiner, open balance. The reporting currency. So much. Where can you get open balance from? Check the trial balance. If you see provision for bad debts in the trial balance, that is what the open balance. Or provision for bad and doubtful debt, or provision for doubtful debt. The word provision simply means allowance. Good. Then you leave a space, 9 space. So then come right, closing balance. You know this closing balance, it represents the balance carried down. This is the balance brought down. Say that for non-account is I like using the open balance and closing balance. And the balance carried down, brought down. If you read the issue of balance carried down, balance brought down, I'm not going to finish now. Around brought down. Avoid brought forward. Let's see what open balance and what closing balance. We are done. Okay. Now what happened is this. This figure will not be given to you. You have to work for it. That's the only challenge. It's in a footnote. So you pick the one on the trial balance, it work. The one on the footnotes, you get this closing balance. Then you compare, and it's all. So all they're going to do for provision for bad debt, do what? Compare. So compare the opening balance, that of the closing balance. The movement, it is what you are going to reflect in the P&L as an expense. All provision is a movement that becomes what? An expense. Not the provision itself. So the movement goes to P&L into brackets, the operating expenses to be specific. Add it to operating expenses. So let me sign it. I write it here. Now, let's do some illustration. This closing balance, you have to subtract it from the receipt. One goes to operating expenses. That is all. Let me do the treatment. Wow. So you know, after these workings, know where each of the items will be recorded. The closing balance that is correctly calculated, or calculated it nicely, can be subtracted from where? The closing balance, or subtract from the trade receivable. Then the movement always should reflect in what? The operating expenses. That's all. We are done. Now let's see some few examples. What if the opening balance is 20, closing balance is 25? What happens? Now the question is, ask yourself, what should I do to this opening balance of 20 so that I can get 25 at the end of the day? I must subtract 5, 10. If I subtract 5 from 25, I'll get 22. Thank you. You add 5 to the 20 so that I can get what? 25. So here we what? 5. That is it. And this 5, when I go to the operating expenses, I must report 5 as operating expenses. So when I go to the operating expenses, if I'll do the extract here. So let's say operating expenses, I'll put 5. And direct after provision for bad debt 5. I'm done. Operating expenses. Now, then I'll subtract this 25 from which figure? Trade receivables. And this in this one, we'll be doing it too. You normally pick the opening balance of the travel and subtract, right? Because you're not touching it in the footnote. Now, it's the closing balance that we have to subtract. How we get it? So it's no longer the opening balance that we subtracted from the travel balance. So it's the closing balance that we need to subtract. Okay. So that is how we are going to work for it. Now let me try another one again. What if here happen to be 17? The closing balance is what? 17. Perfect. When I let 3 like this, as it is now, operating expenses do kindly subtract. That is all. Don't see the sign. Let's only. Now, let me go a little bit deep. So 0, nothing comes here. Meaning that this is interpretation. At the start of the year, you have some 20,000 to be there for all managers are not going to receive fine. But of the year, after your analysis, you still need 20,000. Do you need to top up the money? No. You need 20,000, which was available at the start of the year, so no top up. The first person I saw here was 25, right? It means that provided 20,000 from the previous year, money that you kept aside towards people that will not pay your facilities or the receivables was 20,000. But at the end of this year, after your assessment, because of the COVID, many people will not pay. So it has increased it to what? 25. That means that 20 that you provide already is not enough. What do you do? Top it up by adding 5 to it. And that is why that 5 becomes what? An additional expense to you. How do you get this? Good news. Okay. So that is it. Now let me go to a terrible case. A terrible case. Cash. And here's 20. Tell me. I haven't used it. Meaning that at the start of the year, we have nothing there. Like at the start of the year, no provision and trial balance. If not get any, not set any money aside, don't have anything there. But at this end of the year, we want to say something, and we said to them, yeah, what happened? So, good. So it means that what should I do to dash so that I can get 20? I must have 20. This is called first time of provision. Your first time of making provision, don't have any open balance there. And the first time of provision, the provision itself is the same as the expense. That is all. Every provision, the first time, the provision itself is the same as what? The expense. The subsequent years is the one that you record what the difference, the movement. That is all. So here too, I'll come and then add 20 to my operating expenses. And again, this 20 goes to where? A balance sheet. I will subtract from where? The trade receivable. Good. Now the last one. And done. Here's 20. Here's dash. Here's 20. And then here's dash. So 20. And then this is dash. What happened? It means that at the start of the year, I have 20 series there to cater for all my losses this year. But upon a careful assessment, we don't have any. In fact, all facilities have been paid. Nobody is owing us. Oh, if nobody is owing you, do you make any provision for owing? No. So therefore, what happened? There's dash. So that means I must, in fact, spend all this money that I have so I can get zero. So at the end of the day, operating expense becomes what? 20 negative. And nothing goes to the trade receivable. Don't subtract anything from it because the closing balance is what? Dash. Have you seen what you have done? You are going to meet one exactly in your exams. Yes, I might not be able to tell you the exam style that you are going to meet. But exactly one will appear nicely for you. Either increase or decrease. In short, let me give you a short cut. If it increases, then the movement becomes an additional expense. If your provision increases, it's an expense to you. But if your provision reduces, it's a what? A loss, a gain. So that's why we are subtracting it from what? Your expenditure or your operating expense. So that's a treatment. Yeah, done. Now let's learn how to calculate this. Because this is on the trial balance. If it's not, there is no giving dash. I'm done. I move on. This is the some guy. Or sometimes too, if you are lucky, then someone will give you this. That means you have to find this yourself. Okay. Now I'm going to write 3 possible ways. Giving you this. If you're going to understand that 3, that is all. It is equal. Let's see what will happen. Okay. Let's see. Well, let me write how the trade receivable is stated. Great. So sentence number 1. So example, we thought that provision for bad debt or bad and doubtful debt should be like this. So sentence number 1. So it should be provided. Should be, so starting from this, provided or adjusted bracket equal to, so there is just one, adjusted or provided or equal to, let's say 20% of trade receivable. That note, I'm just assuming that the trade receivable figure on the trial balance is 20,000. I'm using my own examples here because I'm reserving the examples in the materials for you. What I do, or you get something to do. Let me use my own example here. Fine. I'm also assuming that the open balance of the provision for bad debt in a trial balance, and the provision for bad debt in the trial balance also happens to be just 2,500. That is all. Just 2,500. So slide number 1. Slide number 2. I'll give you only 3. Out of the 3, we'll be moving around. The provision, all of them start with this. The provision for bad and doubtful debt should be reduced by 10%. Full stop. This arena, I have a lot of versions. Reduced by 10%. So I can even give another version of this. Reduced by 10%. Reduced to 10%. Different. Again, and reduced by 10%. Reduced by 5% of trade receivable. Of what? Trade receivable. Look at all. Then finally, C. A provision for bad debt this one, so reduced by 10%, full stop. Another version, so this is the first version, version 2. Reduced to 10% of trade receivable. Version 3. Reduced by 5% of trade receivable. It can also be reduced or increased. Reduced or increased. And it can also be cheap and bad. It can also be without trade receivable and with trade receivable. How do we go by that? We are just, yes, this one is by 10% without anything here. This one is by 5% of trade receivable. Listen, We're just analyzing the possible ways that you can get this. Let's look at the last one, the C. The last one. Last one. Provision for bad debt or an amount of, let's say, an amount of 3,000 should be provided in respect of what the provision should be provided. An amount of 3,000 should be provided, full stop, against receivables. An amount of 3,000 should be provided against receivables. An amount of 3,000 should be provided against receivables. Okay, so that's the end of the game. I will quickly go through this scenario and then I will probably last some time. So first, let's see. First, in all the traditional figure is what? 20,000. Provision for bad debt is what? 2,500. Okay. So let's see. Solution. First, in all, I need two workings. The first working is the provision for bad debt. And then the second working is what goes to my operating expenses and what goes to my financial position. Financial position, that's trade word receivable. That is all. So first of all, I need to provide workings for the provision for bad debt first. Then post the figures from that account to the operating expenses and the trade receivable in the financial position. Now let's start the first one. With the provision for bad debt, I'll just print out the format. I tell the examiner, opening balance. I'll tell the trial balance, you have opening balance. Or there's opening balance there. The figure 2,500. Even if I write this and run away, there's a trick for you because inform us where it might be. I'll leave a space for the closing balance. The closing balance, I have to pause and perform some work. The examiner said the closing balance or the provision for bad debt should be provided or adjusted equal to 20% of what? So immediately, what's your trade receivable? So find 20% of it. That is all. In fact, the central focus is the last wording. That is where we will tell you where to calculate it. We will look at the last wording. It's very important. And then look at whether you can get 2 or by in a quest. All of them have 2 and I. Let's see. So the closing balance looks at bracket 20% times 20,000. That should give us something like 4,000, right? So I tell the examiner 4,000 here. How we get it? Then you relax for a while, then you come back again. Tell us what's the difference between 2,500 and 4,000? So it has increased by 1,500. So this 1,500, third examiner, it must reflect my P&L. Mr. Examiner, to be specific, it should go toward operating expenses. I am done. Let me go there to record it. So in the operating expenses, third examiner, that provision for bad debt, 1,000 what? 5%. That is all. Now, If you want to tell examiner that yes, you really understand the game, then tell examiner, has it decreased or increased? Tell examiner, increase in provision for bad debt. But do not submit yourself. You don't want trouble. Like myself, just have provision for bad debt, okay? Because if the thing has increased, you will tell us that it has decreased. You are rather submit yourself for punishment. So please, and please again, just have provision for bad debt. You are done. Okay. Then we said that yes. So this is the P&L section. We said that in a financial position, the closing balance is subtracted from where? The trade receivable. So when I go to the financial position here, trade receivable, open a bracket. I tell examiner, the trade receivable is what? 20,000. I am making a provision against it of 4,000. So what is the net of receivable? So 20,000 less what? 4,000, and amount to be 16,000. Perfect. So you put 16,000 in. That's a line. That part is not a line. Good. So that will be 16,000. So now we are done with the first one. As usual, you do one. You do one. One market. Now what happens is, if I should explain this, it means that the provision has what? Increased by 1,005 and it has increased to 4,000. So take note. When examiners are writing by M2, I use capital letters. So by meaning that, yes, rather giving you what? The movement. Two, they are giving you what? The closing balance. So check these wordings carefully. And so is that by that we got the P&L and the two go to the financial position. We are done. Now your turn. You are doing this for me. Just this one. Is that provision for bad and doubtful debt should be reduced by 10%. Reduced by 10%. So let's see. Great. Now let's solve it together. What happened is this. We only have to clean this side. The open balance is still the same. I've not changed it. And then the provision here will change. This figure to also change. Now let's see. Open balance is what? 2,500. And I said that provision for other capital that should be reduced by what? Should reduce by 10%. Yeah, they said full stop. Oh, they didn't say 10% of receivable. So that I'll go and find 10% of what? 20,000. They did not mention that. Here, the last word is very important. Good. So in short, they did not tell us that our trade receiver, this one is not there. So it means that it's on the provision itself, should be reduced, not on the 20,000. So therefore, yeah, I can even record it, it must be reduced by. So by is the difference, right? Operating expenses. So I can calculate that it should go down by what? So 10% times 2,500. And now what? 250. And it says reduce. Reduce means subtract. Go to the closing balance. 2250. Perfect. That's a perfect answer. Then again, you record 250 here. Kindly put it in brackets. Why? Because that's what reduce. Second, you subtract 2250 from your receivable, and it ends there. How do you get it? Okay. So that is that. Okay. Let's look at if it is 2. And then let's see if it is by. And then we move on. Okay. Now look at the second one. This two means the closing balance. So in that case,
Hold on, so this time you're adding of trade receivable.
no, we are still 10%. No trade receivable. The trade receivable affect what? The last one.
Yes.
Okay. So it will be something like this. Reduce 2. 2 means the closing balance. So I write the balance, carry down here. Open the bracket, find 10% of this figure. I'll get 250. And the difference, 2250, that means I'll do what? Subtract because reduce. Now right here, must reflect the P&L bracket the operating expenses. I will now continue the game. So finally, let me hit on this. Let me hit on this. And this is a writable situation. Yes. It happened in October 2018, 2019 in Webpack. So let's see. The provision should reduce by 5% of trade receivable. To reduce by what? 5% of what? Trade receivable. So let's go. And I just so in this case, the provision for bad debts in operating expenses should be 2,250. And then here 20,000 minus the 250. We solve them in that way. So it's the movement that we record in the operating expenses. And it's the closing balance that we subtract from where? The receivable. Yes. The tracker. Okay. Now let's see something. I'm going to look out for this. Provision for bad and doubtful debt should be reduced by 5% of what? Trade receivable. Have you seen this one? It must be reduced by this time by what? 5% of what? Okay, so let's see how best we can look at that one too. And that is the end of the game. So first, we said must reduce by. Since they say by, well, what will I call it? That is a movement, right? After the examiner, P&L in brackets operating expenses. Open the bracket. Now 5% times this around 20,000 because they said of what? So times 20,000. Now calculator will give us 1,000. And they say reduce. Once you're reducing it, I don't believe what the balance carry down. 1,500. So I will cut 1,000 in my operating expenses and subtract. Then I'll subtract 1,005 from my receivable. That is the end of the game. Basically. Now, as when I'm doing this, success, it will, in fact, all the other questions, they are yours in advance. Just do payments. Good. I'll look out for the last section. Then hit on one item, and we end the game. Let's see. So 3,000 should be provided in respect of what? The receivable. What's the meaning? This is a carry down or is a movement? 3,000 should be made. Probably that is a carry down. That is the closing balance. So can you put the 3,000 where? Here. And then you now record the changes and move on. So in that particular period or scenario, I will have the closing balance of what? 3,000. The movement will be what? 500. Then I'll call it here. Then I'll subtract 3,000 from where? The 20,000. So the last section, they are just telling us that we should make a provision of what? 3,000 in respect of what? The receivable. That is all. Make a provision of 3,000. So if you should make a provision of 3,000, then it means that you've done a calculation for us already in monetary form. So I just have to get my closing balance, which will be 3,000. Yes. Should be. It didn't say reduced by increase. To or by. So the difference between this and this 500. It has increased, right? When I come here, positive 500. When I come to financial position, receivable 20,000 minus what? 3,000, right? Good. And then you put it inside. Basically. Okay. Another note, we are done. Let the last aspect, and we're done for the day. Let me hit on something small. Now I'm going to combine two things together. In situations where you have provision for bad debt and there is bad debt in the footnote, so I'm going to dash the ball and bring those scenarios. That's the last one. And then quickly move on. And next week we'll not start high prices, and I'll give my trial with. Okay, so what if we have bad debt in a footnote at the same time as a provision? How do you treat the entries, or how do you pass the entries? Well, we have bad debts at the same time we have a provision in a footnote. In that case, all what you have to do is this. Kindly follow the rule of bad debts. All debt need to be written off. All bad debt need to be written off before any provision should be made. So I will leave. So assuming that I maintain these figures. Oh, trade receivable is 20,000. Provision for bad debt is 2,500. In a trial balance, let me hit the footnote. In the footnote, this note 1, note 2. Bad debt, let me go straight for them. Bad debt of 2,000 needs to be written off. Bad debt of 2,000 need to be written off. How do you treat it? So first thing that we have to do is what? Write off the receivable. So write off the bad debt against the receivable. That's the first thing. So in that scenario, my provision for bad debt, opening balance, closing balance, and then what goes to P&L? my operating expenses. In my financial position, my trade receivable, what happened to that particular item? I'll go there first and open a bracket. Tell the examiner, this 20,000 that is stated there, it's a lie. 2,000 has gone by, so let's take it off. Minus 2,000. That's the first thing you have to do. So now let me how much? 18. So if you're looking for receivable, is what?
18,000.
Not the 20,000. Oh. Good. Then the 2,000 hit our operating expenses as well. But in my operating expenses, extra. Correct? Bad debt of what? 2,000, right? First things. But there's a bad debt in the footnote. Then let's make the provision. And they said provision for bad debt that would should added or make adjusted equal to 20% of what? The trade receivable. So now I'm going to look for the open balance and the closing balance. The open balance will be still 2,500 because 2,500 here. There's no change that. Now the closing balance will be 20% times what? 18,000. I like that. So now if you stack it on 20,000 totally off, this is practical. Let me explain this. You have given 20,000 out as facility, and you are assessing the likelihood of people that will not pay you. Already 2,000 have run away with your money. So do you add them that they will not pay? No, it's gone already. So on the remainder, let me estimate the likelihood of people that will run away again. How do you get this? So now it's 3,600. You now compare the difference. Which is what? 900 or 1,100. So 1,100 hits your P&L as well. Operating expenses. So I come here, provision for bad debt 1,100. Again, when it comes to trade receivable, this is a habit. We say we should subtract what? The closing balance. So again, less 3,600. Agree. So again, you less the 3,600. So that's right. So this is the bad debt written off, and this is the closing balance of what? The provision. All of them need to be subtracted. Whatever remains, you put there. On that note, I can make it. Now, there was, I don't give a lot of only one, just one. Just one. One. So first, we are going to solve input 2 again. Input 2 is question number 3. We solve the trial balance, the empty trial balance. That's anything balance, fine. We are going to tackle about 4 footnotes. The note that we have treated today. And then you prepare the financial statement again. It can also balance. Any note you treat, if you treat it correctly, it can balance both sides. Not like do one leg and the other. So in Ubuntu, the note that you're supposed to tackle, let's see, note 1, no. We're tackling note 2. And then you go to note 4. And finally, note 8. So far, I just made alone 3 footnotes. Wow, that's good news. So can we prepare the financial statement for input 2 again? This one, I'll take it. And then reflecting only these 3 notes. That's all. The rest, as and when we look at them, we will see.